Hedgeless Horseman here. It's July the 28th, 2024. First of all, thanks to the sponsors. So in this video, I thought I would discuss a few important topics. Because, like I always say, investing theory comes before practice. If you have a bad investing theory or investing strategy, in 10 years you're probably going to lose money or underperform an index. If you have a good investing strategy, you probably make money and beat the index, and the better the strategy, the better your long-term results should be. But as always, that doesn't necessarily show up in the short term. Even if I take my long-term chart, for example, in my portfolios, they are trending up, but I still can have, year-long corrections and all of that. So I kind of look stupid for months or maybe years sometimes. But over the longer term, higher highs, higher lows. So that is suggesting that's like whatever I'm doing, it works over the long term, because the market is not. If you make a good buy, for example, or you make a good decision, or you hold a case, or I should say a portfolio where it's like the average case is a good case, it's good risk reward, that doesn't mean that's going to show up in the short term. Absolutely not. And you're going to lose on some good cases. You're going to lose a lot of money on some cases, well, that you think are good, but it just happens that, okay, in this universe, they didn't play out well. But again, the most important thing is like, if one expects to make money, there's got to be a reason why, or, why should we make money? Most people, as you know, it's more, they see a headline with like silver is going to $50 or $100 and gold is going to wherever. And it's like everybody's going to make a lot of money. So people just buy whatever gold, silver junior basically, and then they're just waiting to get rich. Not too much thought put into it, not much due diligence. It's like, well, what happens if the bull market is a year out or 2 years? In this case, which is the case now. We came out of a 4-year bear market. Do you have a strategy that's like can do that, or are you a very good, let's say, contrarian that you can somewhat pick a major bottom? For example, I certainly can't, and I can't pick tops either. So I'm 100% invested at all times. So I gotta obviously have a strategy which allows me to not need to market time, and that's why we usually go for alpha, and especially I would say I change it a bit depending on what the price levels are out there. So it's like I don't try to market time, but I try to set myself up for the best risk reward given what the opportunities are offered to me in the market. Obviously, in the lows during the bear market low of 2015, beta made a lot of sense. Proven success made a lot of sense, because you could buy success for cheaper than it costs to actually create success. That wasn't bottom timing. That's just me reacting to what opportunities the market is giving me. It's like, where's Mr. Market? The least rational, let's say. It's like, a project that should be worth whatever, or could be worth whatever. Proven success, maybe it cost 60 million to actually create that success. In this is a decent project and it's selling for 20 million, for example. That doesn't make too much sense, even if maybe at face value the project was actually worthless at that point. But it's like a tier 2 project is a tier 2 project, even if gold is $10,000 per ounce or $1,000 per ounce. So it's like, hey, if anything is gonna become a mine, a tier 2 mine, of course, a tier 1 mine usually is very hard to get really, really cheap, or a tier 1 deposit. But it's like someday that tier 2 mine is going to be, on the shopping block because that's one of the better projects out there. So it's kind of common sense thing. But the first topic is tactics versus theme, and here is Rick Rule briefly mentioning that.
If you're attracted to a theme, and you're attracted to a theme in the 5 year time frame, don't try to employ short term tactics around long term strategies. In fact, use this price volatility to your advantage. If you don't know enough about a sector that you can't stand the volatility, leave the sector. Go do something else sensible with your money. I would say that's my general comment.
So I mean, that's only a few sentences, but it's like hugely important. Um, I mean, one could apply that to a case or whatever. It's like when I write my cases, for example, I kind of lay out the risk reward, and sometimes I actually have some kind of timeline, or it's like we at least have to be asking these questions, or you got to be on board for when these questions are asked. Otherwise, the case doesn't really make sense. Or it's like, hey, I mean, sometimes it's just as easy as, hey, I think their current project is worth this much. A ballpark figure. Let's say I think it's worth 3-4 times what the price of the company is selling for. And then they are going to be out there exploring. I mean, in one sense, one could say that, hey, the strategy in that uh, case is that you simply wait until it gets revalued by 3-4 times. I mean, if we go into a really hot market, they're going to trade over the actual intrinsic value. That's just how it is. But it's kind of a simple strategy. I buy and hold until it's not this cheap anymore. And when it's not this cheap anymore, I will have made money. So that has nothing obviously to do with like short-term tactics. Should I be trading that? No, the whole case is simply that the value is a lot higher, and that's going to be recognized when the sentiment in the market improves. You don't know when that's going to happen, but if there's a large enough gap, that's going to be worth it, even if you have to wait 1, 2, 3 years maybe. Because I mean, if you get 200% in 3 years, that's actually great, a very, very good return. If you can compound at that rate, that is absolutely obscene. But obviously, in reality, most people use short-term tactics. Because every single day, on Twitter, for example, you're flooded by guesses and a lot of traders. Like, you should be selling your miners and gold now because they think that the next short-term leg is down, or the opposite, you should be buying because the next short-term leg is up. I mean, we've had many bear and bull markets declared just within the last month, basically, or 2 months. When gold is going up, people talk about, you should be in. When gold is going down, they say you should get out. Those are short-term tactics, like momentum trading. Does that actually correspond with the strategy? I mean, take copper for example. Uh, if you think like a lot of people, it's like, oh, the copper supply crunch, or the demand supply fundamentals are improving, and it's gonna get better and better over the next few years. If you buy something that's very cheap now in the copper space, let's say a developer, it's like you kind of have a time frame there. I mean, if you say it's like, oh, within 5 years, the copper fundamentals are gonna just be improving, then you have a 5 year time frame. But if you own something really cheap, which would, in a better market, trade a lot higher, but you're trading it trading it at the lows, that makes really no sense, because it has you can be trading a crypto or something that's overvalued in that case, because there's always going to be volatility. But what's the actual strategy in that case? And I mean, take Felix Zulauf. He believes there's commodities will do well until the end of this decade. In that case, if one assumes, hey, there's a 6-year-long commodity bull ahead of us. And of course, we've seen copper retrace and all that. But it's like, hey, if that's your plan or belief, like for the rest of this decade, on average, the commodities are going to be trending higher, and we know everything is cheap. Then your holding period obviously is to the end of the decade. But if you short-term trade, which most people do all the time, it's like, or best point might be, for example, now this is gold, not the miners, but anyway, it kind of corresponded. I mean, down here, the big, in my opinion, play or strategy here is that, well, they're the cheapest they've been since 2008, the miners. The next big move, inevitable big move, is going to be higher, not lower, because the big move has already been down. There's only one way that it can, one direction a big move can happen. It's not going to be down when the big move has already been down. Do you need to short-term trade that like everyone else? No. It's just buy, 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 buy. One day, they're going to be a lot higher. And I remember, again, my portfolio, I started investing around August here 2015. I started buying, buy, 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 buy. My portfolio went down like 54% in 4 months. My strategy again was that they're going to be a lot higher, or that was my theme, that they're going to be a lot higher one day. And one day they bottomed, then the portfolio went up 500% in 8 months. No short-term trading at all. The theme and grander plan was that the entire sector is going to go up one day from these ridiculously cheap levels. And they did, and I was a part of it. But if I was a short-term trader or use short-term tactics, maybe I would have sold the low because this looked like a breakdown, for example. That's not where even up here, it's like at any extreme, there's no obvious direction in the short term necessarily. But the big opportunities, obviously, at an extreme is to go to the other extreme. So it's like common sense thing that nobody really actually uses. And I mean, I was trying to come up with, some obvious strategies, or where the case doesn't really afford short-term trading necessarily. It's like inflection. You heard me talk about inflection a lot of times. They have 30 target areas. My case for inflection has been that if you do a fire and forget strategy, it's like, okay, if they're going to be testing 30 targets, and I think it's very cheap given that no chance of success is priced in, and you obviously only need to get lucky once given how big the targets are and given how cheap it is. If they are lucky once and make a significant discovery, it could be a very fun ride, let's say. But let's say you buy inflection and you're only aboard for the next set of drill results, let's say, the next news release. What are the odds that they're going to make a significant discovery on the very next drill release? Probably not high. So in that case, okay, let's say you buy inflection and it's like, oh, I'm just going to be in for the next news release. Let's say they don't make a discovery hold. And even though it's cheap, and again, in my opinion, too cheap, let's say it sells off 10-20%. Because that might be how the market is. And you sell, let's say, at a 20% loss. Was that a good case, or did that correspond with what an actual good way to play inflection would be? I wouldn't say so. To take one news, the upside risk and downside risk of one news release. That is not the opportunity that I see in inflection. The opportunity that I see is that, again, they have 30 targets to test. So when all 30 targets have tested, I think there's a pretty okay chance that the current price will look very cheap. And if that happens, it might go up, X amount of times. So the only thing that really makes sense for inflection, in my opinion, either you buy after a discovery hole, you might pay up, depending on how good the hole is, of course, maybe 50 or 100%. That might not be a bad strategy, actually. You buy after it's been de-risked, there's probably plenty of upside. The other one, if you actually take as a risk, which I'm not the biggest proponent of taking as a risk, but the trick with inflection is that, again, they have 30 targets. That's a lot of news releases, and you only need to, get lucky once. So either you hold through it all and use all the 30 lottery tickets, or you play all the 30 kicks at the can. If all 30 turn up with nothing really, you might lose 50%. But if any one of those come up with good results, you might make a lot of money. Short-term tactics in inflection, to me, makes absolutely no sense, unless, again, it's if you're playing the, let's say, I'm gonna buy after a discovery hole has been made. Yes, you pay up a bit, but it might have been de-risked and all that. So like, same company, but you can play it 1,000 different ways, and a lot of ways doesn't really make sense. So again, it's like, I wouldn't have a big problem with, like, if somebody just had inflection on a watch list, for example. Well, I'm gonna buy after a discovery. Maybe they don't make a discovery, so you never buy it. Maybe they make a discovery on the third target they test. And again, yes, you pay up a bit, but it might be de-risked, let's say. Or it's like, oh, I'm gonna buy here at cheaper levels because I know there's 30 cans to kick. So it's like, if all those 30 cans are kicked, if I get lucky once, I'm obviously gonna make more than the ones that buy after a discovery hole, for example. But at the same time, I'm gonna take more risk because I'm taking the risk is that they could theoretically miss at all 30 targets. I hope that makes sense, but it's like, that's a huge thing. Or if you traded inflection or whatever, it's like, that again doesn't make much sense to me, because there are only two, in my opinion, ways to really play inflection with risk reward that makes sense. Either the more traditional buy after discovery, or in this case, because they have so many targets, etc., that it's so diversified to the upside, in a sense that, hey, holding into as a risk for inflection actually might make sense, whereas like for 99% of pre-discovered units it might not make sense. So it's always, the theme or the strategy is, that depends on the fundamentals of the company and how you should play that. So yeah, again, it's like, it have to correspond with the actual case. In some cases, the conclusion I have in some articles I write about cases is simply, it's like, hey, I think the opportunity here is that if I buy it at this price, give them 2 years, or whatever, more maybe, I think I'm gonna make money. Simple as can be, basically. And obviously, there's got to be a reason why you think that's the case. But again, that rules out, none of my cases have typically anything to do with trading. Almost no one. It's like short-term tactics or anything like that. Because that's not where I think the actually no-brainer opportunities are. It's the same, again, here at an extreme. Is there an no-brainer? It's like, at the peak here, was it obvious that it was going to go down and start a bear market the very next day? No, it might as well go up. So short term, it's like, even at extremes, it's extremely hard to know where the direction is. So in the short term, there's no real opportunity. But if you look at the long-term opportunity, well, the cheaper it gets, the obviously the longer-term opportunity is to be long. And when it's extreme to the highs, the obvious non-opportunity in the longer term is that it's actually gonna go low because everything is expensive. Um, but then also optionality, and here's Pierre, and he's talking about optionality. Why? I mean, he has made billions and billions. Well, not him personally, billions and billions perhaps, but he's made a shit ton of money, probably maybe a billion, with his optionality companies or royalty companies.
And I always say, give me free optionality and I'll make you a millionaire, because optionality in our business is not understood, and it's undervalued because no one calculates it.
I mean, that's a big thing. So he's talking about, again, Mr. Market, that he suggests that the market in this sector is very poor at pricing optionality. In his case with the royalty business is that, I mean, if he buys a royalty on a property, for example, he might pay up for the, let's say it's an operating mine, he might pay somewhat of a fair price for the producing asset, the revenue, the current revenue. But he gets all the upside in the project for free. If they find a satellite deposit, if they extend the mine life because they find more at depth, whatever, whatever. Because that's how he made his, I mean, his best deal, which he talks about in this interview, is when he bought the royalty on in Nevada, where the gold strike discovery was going to be made, that amounted to 50 million ounces. He bought a royalty when there was only I think a 600,000 ounce mine there from a few pits. So he paid a pretty low price just for the producing asset. So obviously, by definition, then all exploration upside, he bought that for free. So he took no risk. That was risk-free upside. And they ended up making one of the largest discoveries that ever been made in the gold space. And he became, probably a billionaire off of that, or it set the foundation for him to become a billionaire. That's obviously a huge edge, because everyone says that the market is supposed to be efficient. He flat out tells you that optionality is something that the market is very poor at pricing. Well, that's a huge thing to be aware of. Oh, as he says, give me free optionality and I'll make you a millionaire. That is, again, that's a huge edge. That's something we should be thinking about all the time. And I would say most of my cases, especially the larger positions, tends to be where I think I'm buying what's already proven for much cheaper than it's worth, and I get all the exploration upside for free. Free optionality. If they don't find anything more, I don't think I'm gonna. I think I'm still gonna make money. If they find something, I didn't pay anything for it, so I captured the full upside, and I took no risk, because if they don't find anything more, I'm still not gonna lose money. He goes on to say in this uh, uh, interview, he talks about what he asks his employees, whatever, when they're looking at something. It's like, do I get my money back, or when do I get my money back? So he kind of secures the downside, and then he gets all the exploration upside for free. I mean, it makes me think of the Sun Tzu phrase, put yourself in a position where you can't lose. I mean, in markets it's hard, and obviously in a battle, it's. I mean, theoretically it's possible to lose, of course, but it's like, statistically speaking, since we're not going all in on any single case, but I mean, if you have a portfolio of 20 cases where you think that, hey, the upside is at face value there, or the downside at face value, there is no downside. Where it's like you have 20 cases and you all think that what's already proven is worth 2-3 times or what you have, or what they have confirmed in the ground or whatever, and they have plenty of upside beyond that, which you're not paying for. Yes, on a case by case basis, obviously something can happen, but it's like that portfolio is gonna kick absolute ass. And typically you find those cases obviously at sentiment lows, like we have in the junior space right now, for example, even with gold at 2,400 almost, where you buy something proven success without taking risk. You're buying stuff for less than it's worth, and if they have exploration upside beyond that, which again you're not paying for, so it doesn't really, you're not going to lose money if they don't find anything more really. It's just that you're going to make a shit ton of money if they actually do end up finding something more, because if you expect a three bagger just based on the margin of safety and they end up finding something else, maybe that's not going to be a three bagger, maybe that turns out to a 10 bagger or whatever. And if you have 20 of such cases, you're absolutely going to make money, even if a few of them actually fail. That's like, oh, the margin of safety you thought was there wasn't there. Then there's, of course, where you have the, let's say, if there's a bad management team that they, can mess up something. It's like, oh, a shitty team is bringing an asset into production, and that was your margin of safety, and they messed everything up because they don't know how to build a mine. Those kind of things play in as well, obviously. Or something happened that you didn't foresee. I mean, in the case of we have recent examples where it's like red pine, for example. I thought there was margin of safety there, and then they came out with the CEO has fiddled with the assay results. I mean, even with the fiddling, with the manipulation, it looks like there's actually, I mean, there's obviously a gold deposit there, but it's like the margin of safety turned out not to be as good as it looked, because they had exaggerated some assay results, for example. But if one would think that, hey, the Red Pine mine, the Wawa gold project, I mean, if that's, oh, it's probably already a mine, let's say. I mean, then you kind of have margin of safety, and the exploration potential in that case would come for be in free optionality. So it's like if we look at types of companies, let's say, or subsectors. I mean, in major miners, I don't like major miners. I mean, where's the optionality? If I look at Barrick, Agnico, and Newmont, for example, is there free optionality there? Is there, especially if we're talking large optionality? It's like, first of all, I don't think any of them are really that cheap based on their producing assets, which are obviously running out of mine life every day, unless they find more. So where's the big optionality there? I mean, one could say that if I pay a fair price, an okay price for Barrick, Newmont, or Agnico, and they have exploration success, or they have a lot of exploration assets, one could say that yes, that's free optionality in that case, but it's not huge. I mean, if you're a $50 billion company, it's not like, whoa, all of a sudden they found $150 billion discovery, and it's gonna three bag. That doesn't seem realistic. I mean, a $2 billion project is hard to find today. So that I don't see the risk reward in major miners, because like if gold prices go down, obviously the value of their producing mines go down because their cash flow goes down. If they go up, if the gold prices go up, they'll make more and you'll make money. So it's much more of a typical beta play in my opinion, and I don't think it's starting off really cheap. So I don't know what the obvious next move is for most gold majors. Again, if they're kind of fairly priced at today's gold price, if gold goes down, price should go down. If gold goes up, well, price should go up. I don't see any obvious no-brainer, and especially the bigger they get, it's going to be even harder to have free optionality, because the exploration success that's not maybe priced in by the market still has to be so much larger. So I would say it's like the developers, for example, today, uh, they are better because they tend to be cheaper, because the junior sector is where the opportunities are. It's the junior sector that's destroyed. But then you of course have some where it's like, oh, it's a very mature asset, maybe not much obvious exploration potential. You can buy it on the cheap. Well, yes, in that case, it's you have margin of safety. You have the beta trade. You're probably gonna end up making money on it, maybe a lot of money when the sector turns. It's like I think Rule, for example, talked about. He got asked about Seabridge. I think they have, I don't know how many ounces, like 30 million ounces. Low grade resource. I mean, one could say, and he talks about that. It's like, you know, I mean, that's a huge, in a sense, optionality play as well. Uh, just from huge beta, where it's like it might be priced like, I don't know what the price is, but it's like, yeah, one day the sector is gonna go become hot, and if you think that the gold price is gonna go to $4,000 in the next 2-3 years or whatever, that's probably gonna reprice a lot, and until then it might not move much. It was like that's probably gonna happen one day. The sector is gonna be hot one day, and then you're gonna make money. So in a sense, it's kind of a free optionality play, because it's let's say trading as uh, it's not gonna be a mine, but someday, because this is a cyclical sector, it's probably gonna trade like it could become a mine. So that's one way. That's not exploration optionality, obviously, but that just comes from, well, I'm buying this huge beta play at the low of a sentiment cycle. And explorers, I mean, they are the ones where right now, for example, the funny thing, well, yeah, funny or funny, but it's like I recently listened to an interview by Brent Cook where he said, he's mostly focused on exploration. And again, that kind of makes sense. Alpha has been the only thing that has worked, because you see the beta, you see the proven success. The juniors aren't getting much for the proven success. They're trading at, I don't know, 10-20% of NAV, for example. I mean, even the better deposits are trading for much less than what their economic studies at least suggest. But discoveries can still move. We've seen ramp metals. We know what happened with Snowline. We have, I mean, this goes back a few years maybe, but it's like the Hemai discovery by De Grey, yada yada. So the only one that have really been able to perform over the last X amount of years have been the exploration plays. In a crappy market, it's only the really really exciting exploration stories that typically go up. Uh, my view on that is, yes, that has worked, but as the beta gets cheaper and cheaper, I actually think the risk reward is, the inevitable trade is getting better and better. So I understand where he's coming from. There's like exploration is the only thing that is really working so far. But that was the same down here as well. And I mean, the longer beta had failed, if from here to here, all the beta plays went down a lot. The only thing that really had any positive performance over this time frame would have been discoveries. So at the bottom here, you had a very long period of only exploration plays working out really, but at the same time, when that has held on when that's been true for the longest time, which I mean peaked obviously at the bottom in terms of time where only exploration has worked. This is also when the merit of beta hit its peak, and where you didn't need a discovery because the beta plays were going to be the absolute best performers over this time period, and the whole sector went higher, especially the beta, let's say. So I think it's not a bad move, because if you're very good at exploration, you can make money probably through the entire cycle. It's just very, very hard. And I would say, again, the risk reward simply goes up when the whole sector trades cheaply. Because if he's only focused on exploration, if the market goes higher from here, if we've had a bottom in juniors and the betas are going to perform over the next 3-4 years, and that's maybe relatively a relatively low risk strategy. If he's in a good exploration stories, they're going to go up as well. So it's not like he's totally missing out on anything. It's just that, hey, if there was any time where I think the risk reward was good for, development optionality or gold in the ground optionality, that would be around these levels. Because I think one could make a portfolio right now with only proven success stories, let's say, where they have big resources, developers basically. And I think the question is more a matter of when, not if you're going to make money. Whereas in the exploration space, it's always, if you don't have margin of safety, it's always an if question, not a when question. So that would be my only caveat to that. And my preferred vehicles obviously now is the hybrid cases. Well, that's typically true always for me, but it's much easier at sentiment lows where you can actually buy ounces in the ground for cheap, and then by definition all the exploration becomes free up optionality, like Pierre Lassonde talks about. And an obvious, or a few obvious cases for that would be like, First Nordic, for example, where I think the Barsele deposit as it stands right now, I think is worth multiples of the current market cap. So I get, in my opinion, all the exploration potential at Barsele. I get that for free, as well as, the rest of the 100,000 hectare land package. That exploration optionality is also for free, because if they don't find a single additional ounce, really, I think I'm gonna make money on what's proven in Barsele. But if they find anything, I'm gonna make a lot more money. That is very compelling optionality to me, because at face value, you're getting not maybe the full upside. I mean, if Barsele was a pure grassroots explorer and it would be valued at 20 million. Obviously, there's more theoretical upside in absolute terms, but I still could get huge benefit from these prices just from exploration. Whereas I think I have my downside more than covered just from the existing. So it's basically you almost get the full potential from exploration without taking any risk for exploration. Whereas, yes, in case of inflection, for example, there is no margin of safety. It's just huge exploration upside, but it's not free. It's not free exploration upside. But from a risk reward, I don't see how you can beat this. I don't see how you can beat the proven beta margin of safety. If they have, I mean, obviously the more exploration upside the better, the cheaper they are to what's already proven the better, because if we just consider, let's say this is the price right now of a company, this is the proven success, for example, that you think, oh, this is a gap that's going to get closed, and maybe it's actually going to surpass that if the market gets really hot. So, but let's say this actually is the when return. There's like the at face value inevitable return, where I think, hey, I'm gonna get 200%. Let's say it's a matter of when, not if. I mean, that's superb, even if it takes a few years. But then you have the exploration potential as well, that you can actually go to somewhere like this. I mean, then this is kind of the banked future returns, which is absolutely great. It's like at face value almost risk-free upside in a sense. but you have the free potential to not go here but up here in terms of value, and you didn't pay for it. So in a sense then, the probable upside is this, but the actual potential upside span is this much. And if you don't take any risk for this scenario, I mean, Jesus, that's a good deal. Whereas again, with inflection and expiration stories that don't have any real margin of safety, there is no probable returns. The downside is theoretically, well, at least let's say 50% of the price, and then this is potential. And that potential in some cases might be 20%. So there's 80% chance they're not going to discover anything, 20% chance they're going to make a significant discovery and I'm going to make a shit ton of money. But it's like from a compounding perspective, compare that to, let's say, almost 100% chance, given enough time, that you're going to make money on it, and then there's 20% chance, let's say, that you're going to make a shit ton of money on it. I mean, from a compounding perspective, nothing beats the hybrid plays in that case. If you have 20 stores with that kind of risk-reward characteristic, that's gonna, I mean, yeah, you can't almost beat that. But at the same time, if I had 100 inflection resources with 30 targets each, that would be so diversified because you would have 3,000 targets, and you might need, I don't know, 5 to 10 stores out of 100 to actually make a significant discovery. So out of 3,000 targets, you might need 5 to 10 of them to actually make a significant discovery, and it could, let's say, theoretically, well, let's say 10, and that could multi-bag your entire portfolio. I mean, it's so diversified to the upside that it actually, from a mathematical standpoint, would make a lot of sense, because there's always also the chance that they would make 30 discoveries, let's say, out of 3,000 targets. In that case, maybe the portfolio would do super well. So I mean, yes, there's caveats to everything, but there are not 100 inflection resources, for example, so it's kind of a moot point. So any time, obviously, if you have the high risk approach, but mathematically it's a superb risk reward proposition, then you have to mind the position size, because the best mathematical high risk high reward case, if you go all in on that, for example, if it's really good expiration success probability of 40% or something, then there's still a 60% chance you're going to cut your entire portfolio in half in case you were all in. And from a compounding perspective, that's just typically unacceptable, unless, I mean, yes, if I started with $2,000 or something, or $1,000, where it's like, hey, I could make the starting portfolio value, I could just save 1 or 2 months and I could get back. Yes, then theoretically I can see that it might actually be worth, from my perspective, to actually take higher risk and try to kind of leapfrog. But that's not something I would encourage, because again, where we are in this sector, there's so many no-brainers out there with probable upside in the next few years that you might as well get the snowball rolling. And if you can find a probable 200-300%er with free optionality, if you can find a few of them, even if you just have, I don't know, $5,000, if I put $1,000 in each of them, that portfolio is probably going to do very well, and then I can snowball. So in that case, it again might be too greedy to simply go for a high risk, high reward. So it's like, in my opinion, the most superior risk reward propositions right now are the hybrids, and the most extreme ones, in a sense, obviously, are the pure bait optionality like the sea bridges, because if they have like 30, 40, or 50 million ounces, they're not going to find 3 times that amount. That's just not going to happen. But so there's no exploration optionality typically. I mean, they could obviously make a discovery that's not an optionality play, where it's like they find 2 million ounces of very high grade stuff. But still, I mean, I assume that's not a big probability. Two, it's probably not so cheap that it's like, oh, in that case, I'm gonna make. I don't know what it's selling for, but it's like if Seabridge is still selling for $200-300 million, and the project could be worth like 5 billion or whatever. That's the obvious bait optionality. And if they make another discovery, it's like, yes, that's also value added, but it's like probably not going to compare that well against what's already proven, and it's not going to overshine the flagship project, if you know what I mean. So yeah, that's a somewhat of a rant on a few points. I haven't even covered jurisdictions. I guess I'll talk a bit about that. So it's like when I think about jurisdictions, I mean, this happened where there was news recently that the leader of Burkina Faso, in a dramatic move that reverberated across Africa and beyond, he announced the expulsion of all foreign mining companies to regain control of Burkina Faso's gold resources. This decision directly impacted major companies like B2 Gold, Nord Gold, Endeavour Mining, Semafo, Fortuna Silver Mines, and Hummingbird Resources, disrupting Western businesses. So all of a sudden, it seems, I don't know actually what, if they just get thrown out or they have to give up the project, or if there's a caveat or whatever, but let's just assume, okay, they get expelled. Like, oh, these are not your mines anymore. That's obviously a risk. It's like you could have thought, it's like, hey, we have good mines in Burkina Faso, and that's where we get the margin of safety from. All of a sudden, you don't have that margin of safety. It's like the most de-risked thing, a good mine, operating mine, proven that they can make money on it. Let's say there's 5 million ounces of gold left, so it's like, yes, if they just operate, this mine alone is worth, let's say, $2 billion or 500 million, whatever, depending on how big the mine is, obviously. All of a sudden, boom, all of that is gone. At least for the time being, but it's like, at face value, boom, that's gone. I don't want that. It's like, if we see gold go to 4,000 or whatever, it's like, take a future where it's like the debt problems and the US dollars, it really starts to, the shit is starting to hit the fan, and gold gets revalued, and everybody's fleeing to safety, and you're scared. It's like, oh, Jesus, gold has sold out, silver has sold out, physical, the price just keeps ramping, like 2011, for example. I want to know, there's like, I own gold. I own gold in the ground that I bought for $10 per ounce. Now it's worth, whatever, $200 per ounce or something. I don't want that taken away from me. Whereas like when I need it the most, when it's most valuable, boom, that's gone. So you have a few, angles to this jurisdiction thing, where it's like, is there a lot of prospectivity in Africa, for example? And obviously there's better and worse jurisdictions in Africa. But it's like, yes, there's obviously a lot of potential in Africa. I own some African explorers, like Alpha Exploration, for example. I think they have, could have a multi-million ounce gold deposit. Would I want to own a miner in Eritrea over the long term? Probably not. But you can probably get stuff permitted there. Mining companies probably know that, so you can actually monetize what you found there. maybe a lot easier in a sense from an operational standpoint than Western jurisdictions, because as we know, in Canada or whatever, it's like most Western jurisdictions, it's permitting that's the biggest hurdle actually to monetization, at least from a mining perspective. It's like we've seen Montage Gold in Côte d'Ivoire or Ivory Coast. I mean, I think they're pretty much permitted to build a mine, and that only took a few years. So if you want to build a mine, if you want to, yeah, if you discover something and want to build a mine quickly, then Africa is probably, many parts of Africa, probably some of the best jurisdictions in the world. But would you want to discover a very long-lived asset, like a 50-year copper porphyry, where it takes 5 years to get your money back? It's like even if you bet on, it's like, hey, I'm gonna play this out the entire case, like this is gonna be a cash flowing operation. I'm gonna see it to the end. It's like I could, this is a mine it could take 5 to 7 years to build, but that's going to make money for 50 years. So it's like, yes, you'll make a lot of money over 50 years if you hold it to operation, or you buy a developed project, for example. It's like, no, I mean, I'm not too comfortable with that. And that's why I think it's like, then I would focus on IRR if you're gonna play that. It's like if a company can make its money back on a mine in 2 years, beyond the 2 years, all of that is free upside. But if there's a 5 year payback period, and it's a 50-year mine life or 20, 30-year mine life, where it's like, okay, it's gonna take a while to get back the money that you put into the project, and for it to really, I mean, for the full value to be realized, it's going to take 30 years. And you know that, hey, I mean, this is this might be a jurisdiction where that could get taken away, especially in good times. I'm not too it's like, if I were to hand over, let's say, if I bought a mining projects and would hand that over to, let's say, my future children or future grandchildren, I would want them to be long-lived assets in typically Western jurisdictions where they're not going to be taken away. It's like the iron ore business in Australia, where the what's their name, the Hancocks, the Gina Reinhardt or whatever her name is. Like, some people have made a shit ton of money on iron ore royalties. Huge mines, long-lived operations. It's in Australia. They have not been nationalized, etc. That's how you make a crap ton of like generational money in a sense. Whereas like, oh, here in Burkina Faso, if you find a long-lived generational asset, boom, that's gone. So that's like, I'm putting more and more emphasis on jurisdiction, where it's like, if they find gold or if they have gold, I want to keep the gold. I don't want it to be a scenario where it's like, when I am the happiest that I bought gold in the ground for $10 an ounce or $20 an ounce, when it's worth $200 an ounce, I don't want that to get taken away from me. It obviously, to me, seems that I mean, a lot of the miners, they seem to be focusing in on Canada, etc. I mean, there's a lot of M&A activity that's been going on in Canada. I think simply because the miners know that even if, let's say, permitting is hard, but they're thinking the very long term. If we want to build a sturdy mining company, for example, we want the, let's say, core holdings, or like the backbone of the companies, to be in a place where, if we get to build a mine, that's not going to be taken away from us. So permits in the West, obviously huge value, whereas permitting in Africa, that's not maybe such a big deal. That a project that has a permit, while another project that does not have a mining permit, but it's like, oh, it's only going to take them 3 years to get a permit. So relatively speaking, a permit then, or the permitted project, is not worth that much more than the non-permitted, because you think that they're actually going to get a permit. Whereas in the West, it's like if you have a permit or a probable path to a permit or whatever, that might be a huge thing, because not only can you build a mine and monetize it, but also you're probably going to get to keep the full benefit of it. It's like if it's a 20-year mine life, that mine is going to throw off cash to the mining company for 20 years. It's not going to throw off cash for 5 years and then some military leader is going to say, that's our mine now, so you lost 15 out of the 20-year mine life. So yeah, in Africa, it's like IRR I would look at, or to cut it short, I would want juniors that really focus on proving up something big that's going to get acquired, or could get, let's say, built with a high IRR, really sturdy project, not huge capex and all that. Let's put it like this: I want a quick exit. I want a quick exit. Because if you look at some countries, it's like, it's also cyclical. It's like they go socialist, then the country collapses, then they get more pro-business, and then they get socialist again, etc., etc. So if you have a 20-year time frame or something in some countries, there might be 2-3 coups or more over that time period. Whereas, like, yes, in the West we change governments every 4 years or whatever, but it's typically not that. It's like we don't nationalize and then unnationalize and all of that. So you could hit a nice, let's say, period of time where it's like, Chile and Peru, for example. I mean, people have been able to mine there for a long time. I think Chile is getting a bit worse from what I've heard, but some say just like, well, they're never gonna really upend the mining business because it's such a major money maker. And there's a lot of lobbying, obviously, from the very large mining companies that operate the huge copper mines. So that might actually not be that dangerous, but permitting might be hard. It's like Mexico now, for example, when they're going against open pit mining especially. So like, is Mexico on my, like, oh, here is where I really want to bet on finding a big open pit mine? No, not really. But again, in the West, that's what I kind of focus in on: long-lived assets that have some hopes of actually getting permitted. It's like I would like to have a empire of very large real estate, because now everything is selling for cheap, and there's some juniors in Canada, for example, they're very huge land package. Most of them don't have that much in terms of margin of safety. But let's look at another examples like Western Alaska. We know these CRD systems might be huge. Some CRD systems like Santa Eulalia and what's the name of it? Timok? No. I don't remember, but you can check the presentation. I mean, some of those CRD systems, they've been mined for 100 years, for example, and it's in Alaska. I was gonna say land of the free, no, but U.S. is famous for respecting private property. So if you find a high-grade silver system that's huge and could be mined for 50 years, for example, and you get to keep all of that benefit, yeah, then I mean, that's kind of the best case scenario in a sense. Or if you find a big porphyry deposit in the US, for example, or in Canada. It's like, yes, huge long-lived projects, but where it's like you think that, well, at least, the mining company is going to be able to keep that. So that's going to be worth, the project might be worth a lot because they could mine it for 50 years. Or in Australia now with, I think it's North Parks, that Evolution, I believe, bought the remaining stake from Sumitomo. I mean, if you look at the Evolution's presentations on North Parks, they have like resources that implies that that could be mined for 90 years. Imagine having a copper operation in Australia where you can get the benefits that it could be throwing cash for 90 years. Your grandchildren, if you own, if you own that mine and it mined for 90 years, your grandchildren could be making money on that mine. Whereas, like, again, in this case, well, you're not even making money on the mines in Burkina Faso anymore. So it's like that is, I don't know, it's just very enticing. And I think it's also very important to think about. It's like, we know Thomas Kaplan has said that he believes there's going to be a, well, he called it the Kaplan Doctrine, basically where a few years ago he got out of all the sketchy jurisdictions. He used to be the, I think, largest single claim holder in Pakistan, for example, but he's like got out of Pakistan and now he's focusing on, I think, North America, Australia, maybe, I don't know if he mentioned, Scandinavia, Europe, but it's like he's sticking because he foresees a lot of chaos happening. So he's sticking to the best jurisdiction from a rule of law standpoint, kinda, where private property is mostly respected, because he thinks that's gonna get a premium, and it makes sense. I mean, if we go into fast forward a few years, we don't know what could have happened. Let's say the world is a lot more chaotic. Gold is at $4,000, $5,000. People are running around with their heads on fire. Maybe tech has crashed for a while, Bitcoin has imploded and all of that, and everybody's scared because the inflation has taken hold and everybody's rushing into safety. Are you going to be, if it's hard to get gold, for example, or you can't afford an ounce of gold, for example, and silver sold out, are you going to be rushing into the next best thing, which is gold in the ground? Are you going to be rushing into Burkina Faso gold mines, assuming that even foreign companies can hold Burkina Faso gold mines at that point in time? No, I don't think so. When you're scared, you're focusing more on preserving wealth, risk, than you're thinking about upside, obviously. In that case, Thomas Kaplan believes that there's going to be a bubble within a bubble, meaning what he means, a bubble in valuations for Western, let's say, focused or domiciled or Western mining companies, like mining companies or deposits or mines in Western jurisdictions. He thinks they are gonna, when gold goes into a bubble, maybe the mining sector goes into a bubble, he thinks that projects, miners in, the West are gonna fetch even higher premiums because of the safety factor. And I can kind of see that. And as always, if that's a free optionality, that's great, because I can see a scenario where that happens. And if I'm not paying for that scenario, that's a free optionality. If that's not priced in at all, the fact that that could happen in the future, if it happens, I might, let's say, if we go into a mining bubble, it's like, oh, I'm gonna make 1,000% on my portfolio. If they get a premium, it's like if they really go into a bubble and I hold mostly, let's say, the better quote jurisdictions, maybe I'm gonna make 2,000%. If that's in the back pocket, it's like not a necessity for me to make a lot of money. I just need the sector to get back in vogue. But if I have that as a free optionality, sign me up. Whereas like if I only own companies in the sketchier jurisdictions, I might get 1,000%, but there's no optionality of that going to 2,000%. It's more an optionality that they might take away my assets. So in that case, that's a optionality to the downside in a sense. I hope that makes sense. If I talked about any companies, consider me biased. I might own them. They might be sponsors and all that. This is not investing advice. Don't invest money you cannot afford to lose. This is not a buy or sell recommendation of anything. Do your own due diligence. Again, consider me biased and all of that. Thanks for listening. Bye bye.